Your credit score is a three-digit number that reflects your credit worthiness, or how likely you are to repay your debts on time. It is based on your credit history, which includes your payment behavior, credit utilization, credit mix, and other factors. Your credit score can affect many aspects of your financial life, such as your ability to get loans, credit cards, mortgages, insurance, and even jobs. Therefore, having a good credit score can help you save money, access more opportunities, and achieve your financial goals. But how can you improve your credit score if it is not as high as you want it to be? And why does it matter so much? In this article, we will answer these questions and provide you with some practical tips on how to boost your credit score and maintain it over time. Why your credit score matters. Your credit score is not just a number. It is a representation of your financial reputation and trustworthiness. It can have a significant impact on your financial well-being and opportunities. Here are some of the reasons why your credit score matters. It affects your access to credit. Lenders and creditors use your credit score to evaluate your risk level and decide whether to approve your applications for loans, credit cards, and other forms of credit. They also use it to determine the interest rates, fees, and terms they offer you. Generally, the higher your credit score, the more likely you are to get approved and receive favorable terms. The lower your credit score, the more difficult and expensive it will be to borrow money. It affects your housing options. If you want to rent an apartment or buy a house, your credit score can play a role in your eligibility and affordability. Landlords and property managers may check your credit score to assess your reliability as a tenant and decide whether to rent to you or not. They may also charge you a higher security deposit or rent if your credit score is low. Similarly, mortgage lenders will look at your credit score to determine your qualification and interest rate for a home loan. A low credit score can limit your housing choices and increase your housing costs. It affects your insurance premiums. Many insurance companies use your credit score as one of the factors to calculate your insurance premiums or the amount you pay for your coverage. This applies to various types of insurance, such as auto and home insurance. A higher credit score can help you get lower premiums, while a lower credit score can result in higher premiums or even denial of coverage. It affects your employment opportunities. Some employers may check your credit score as part of the background screening process, especially for jobs that involve handling money, sensitive information, or security clearance. A good credit score can demonstrate your responsibility and trustworthiness, while a bad credit score can raise red flags and hurt your chances of getting hired or promoted. It affects your financial confidence and peace of mind. Having a good credit score can give you a sense of financial security and freedom, as you know you have access to various financial resources and opportunities. You can also enjoy lower interest rates and fees, which can help you save money and pay off your debts faster. On the other hand, having a bad credit score can cause you stress and anxiety, as you may face difficulties and challenges in obtaining and managing your finances. As you can see, your credit score can have a profound influence on your financial situation and quality of life. That is why it is important to monitor your credit score regularly and take steps to improve it if needed. How to improve your credit score. Improving your credit score is not a quick or easy process. It requires patience, discipline, and consistency. However, it is not impossible either. There are some proven strategies that can help you boost your credit score over time. Here are some of them. Pay your bills on time. Your payment history is the most important factor in your credit score, accounting for 35% of it. Therefore, the best way to improve your credit score is to pay your bills on time, every time. This includes not only your credit card bills, but also your other bills, such as utilities, rent, phone, internet, and student loans. Late or missed payments can hurt your credit score and stay on your credit report for up to 7 years. To avoid missing payments, you can set up automatic payments, reminders, or alerts. You can also contact your creditors and request a payment plan or hardship assistance if you are struggling to make your payments due to financial difficulties. Reduce your credit utilization. Your credit utilization is the percentage of your available credit that you are using. It is the second most important factor in your credit score, accounting for 30% of it. Generally, the lower your credit utilization, the better for your credit score. A high credit utilization can indicate that you are overextended and may have trouble repaying your debts. To lower your credit utilization, you can pay off your balances, request a credit limit increase, or use multiple cards to spread out your charges. A good rule of thumb is to keep your credit utilization below 30% on each card and overall. Keep your old accounts open. The length of your credit history is another factor that affects your credit score, accounting for 15% of it. The longer your credit history, the better for your credit score, as it shows that you have more experience and stability in managing your credit. Therefore, you should avoid closing your old accounts, even if you don't use them anymore unless they have annual fees or other costs that outweigh the benefits. Closing an old account can reduce your credit history and increase your credit utilization, which can lower your credit score. Instead, you can keep your old accounts open and active by using them occasionally and paying them off in full. Mix up your credit types. Your credit mix is the diversity of your credit accounts, such as credit cards, loans, mortgages, and other forms of credit. It accounts for 10% of your credit score. Having a variety of credit types can improve your credit score as it shows that you can handle different kinds of credit responsibly. However, this does not mean that you should apply for new credit just to diversify your credit mix. You should only apply for credit that you need and can afford to repay. Applying for too many new accounts can generate hard inquiries, which can lower your credit score and stay on your credit report for up to 2 years. Check your credit report and dispute any errors. Your credit score is based on the information in your credit report, which is a record of your credit activity and history. You are entitled to a free copy of your credit report from each of the 3 major credit bureaus, Equifax, Experian, and TransUnion, every 12 months. You can request your credit report online at www.annualcreditreport.com. You should review your credit report regularly and look for any errors or inaccuracies, such as incorrect personal information, accounts that don't belong to you, duplicate entries, or fraudulent activity. If you find any errors, you should dispute them with the credit bureau and the creditor as soon as possible. Correcting errors can improve your credit score and protect your identity. Conclusion: your credit score is a vital part of your financial health and well-being. It can affect your access to credit, housing, insurance, employment, and more. Therefore, you should take good care of your credit score and strive to improve it if necessary. By following the tips we discussed in this article, you can boost your credit score and enjoy the benefits of having a good credit reputation. Remember, improving your credit score is not a one-time event, but a continuous process. You need to monitor your credit score regularly and maintain good credit habits over time. By doing so, you can achieve your financial goals and dreams.